captain has illuminated the seatbelt sign, indicating we are on our final descent. Thank you for joining me for this edition of Numbers Matter Shorts. My name is Bill Wood. And to get going this time, I want to go right to the chart, right to the graph, because I think this is about as pretty a display of a soft landing glide slope as anyone could ever imagine. I don't think anybody could have drawn it in much better than this. Now, it took a couple of years to get here, which is longer than anybody expected or really wanted. And it also took a major revision to the employment data. You probably heard about that. The government subtracted over 800,000 jobs from the past few months of data. But here we are with just a beautiful glide slope. Say a couple of things about it. You can see that early on, it was quite volatile. That made the trajectory very difficult to forecast, and I think that added a certain amount of uncertainty to everything. But in the past year or so, you can see the raw data the changes have been relatively subdued. I calculated the 12-month moving average. That's that nice smooth downward sloping line gradually coming in, and it's right in the sweet spot. Chair Powell said, we do not want any further changes to the employment situation. So that's right in the sweet spot, right where they wanted average monthly gains of 150, 200,000, somewhere in there. That gets all of the new entrants to the job market. That's a growing economy, and that's perfect. So when you combine that with the unemployment rate, which is right at about 4.2, 4.3%, and the job openings data, which peaked a couple of years ago at over 12 million job openings. You remember there were way more openings than there were available workers. That's gradually descended down to below 8 million job openings. And the pre-COVID level was right at about 7 million, and it looks like we could get there within the next few months. So the employment data is almost perfect. And when you think about the inflation data, if it's gradually coming down to the 2% level, then the Fed has accomplished their task. It took longer, but the good news is far less pain in this data than I think anybody really anticipated. So even though it took a while, there wasn't really, the overall economy didn't endure a lot of pain, and now we can go from inflation control mode to economic growth mode. And what's it going to take to do that? Well, the Fed's going to start lowering their interest rate, and it's about time, you are saying, and so do I. But they want to start lowering it. There's a couple of sectors of the market, the economy, that have not fared as well as the overall economy, and that would be manufacturing and construction, particularly residential construction. We know both of those segments were harder hit by this rise in interest rates. And so if the Fed wants to get to growth mode and sustainable long-term optimal growth mode, that's real economic growth in the range of 3%. You adjust for inflation, you get 3% growth. That's what's going to generate the long-term job and long-term wage gains that people want, that keep inflation low and keep profit margins viable for companies. And so that's really what we're trying to get there. But we need the manufacturing sector, and we need the construction sector. Those are what we now need to get to. So are we going to get there? The probabilities look very strong that is what's going to happen. Now you say when. Well, let's get past the risks to the outlook first. Here's how I see it unfolding optimally. First, the election. I think there's a lot of risk in this election. I think most of that risk is negative. It's possible that everything goes smoothly, a smooth transition of power, the House, get a brand new House and a third of the Senate, and nothing too disruptive. But we've seen some things that are kind of ugly happen during recent elections, and we need to get past that. So I think the Fed is anticipating some election blowback, if you will. So I think their first rate cut is only going to be 0.25%, a quarter of a point. They do not want to get caught up in the politics of looking like they favor one side or another, or they're bowing to political pressure. So to kick this off this month, quarter of a point. The next Fed meeting comes right after the election, so I don't know if they're going to want to do much more than a quarter point there, see how things kind of settle, how the dust settles. But after that, they could start lowering the rate by 0.5 percentage point, 0.75 percentage point. There are no rules. And so let's get past the election. Let's get into the holiday season in good shape. Consumers in a buoyant mood. They don't have to set a record, but we don't want them to feel like they need to cut back. And then we get the spring construction data starts shortly thereafter. So get a couple of quarters, Fed reducing the rates, maybe a whole percentage point by the end of the year, get the first few months of next year going, another half a percentage or a full percentage, get the rate down closer to 3. Manufacturing, I think, would start to show some life there. I think the residential construction data, which is a very spring-oriented type of activity anyway, starts to gather some steam, and then we're off and running. Then the upside to the economy kicks in, and we're back close to that 3% growth rate with everybody working and inflation under control. That's the optimal setup. Obviously, this thing can go a lot of different directions between now and then, so this is no time to get complacent. Nobody's doing a happy dance yet, and I will be back with the changes and the recalculating and revised data and reformatting and all that stuff, reformulating as we go, just to make sure. But stay tuned, and thank you again.